All right, welcome to the Explainer from Talk Tickers. Today, we're digging into Medtronic and a situation that honestly leaves a lot of people scratching their heads. The company puts up good numbers, but the stock takes a hit. So what's really going on here? Let's break it all down.
Okay, so check this out. On one hand, Medtronic comes out and absolutely crushes it, right? They beat their earnings per share, or EPS, by 3 cents. And revenue, they beat that by a whopping $200 million. That's a solid win. But then you look at the stock price, and it's down over 3% on the day. That just doesn't add up.
And that right there, that's the big question, isn't it? Good news, bad reaction. Why? How does that even happen? Well, the answer really gets to the heart of what Wall Street is actually paying attention to, and it's not always what you see in the headlines.
So let's get into it. Section 1, the beat and the drop, a classic paradox.
I mean, just look at these numbers for yourself. The headline figures were, frankly, really good. Revenue landed at almost $8.6 billion, a full $200 million more than analysts were expecting. Earnings per share, another beat. And organic growth, almost 5%. You look at this and you think, wow, that's a great report card.
But the market clearly saw something else. There's this term you hear on Wall Street, a low-quality beat. And that's exactly what investors were thinking here. So what on earth does that even mean? Let's dig in.
Okay, before we get to the skepticism, you got to give credit where it's due. Some parts of the business are just on fire. Look at diabetes, up almost 8%, and cardiovascular, up 7%. That's huge. A lot of that is thanks to their cardiac ablation business, which is just exploding. So, their new products? Yeah, they're working. They're definitely working.
And here's the catch. This is the whole reason for the drop. The company raised its guidance for the full year, which sounds great, but when investors dug in, they realized the upgrade wasn't because the business was suddenly selling more stuff. Nope, it was because of things like lower tariff costs, about $185 million, and getting a nice little boost from foreign currency exchange rates. The real growth, the stuff that comes from their core operations, well, that got pushed out to the second half of the year, and investors hate that. It feels like kicking the can down the road.
Okay, but the story doesn't end there. As if the guidance wasn't enough drama for one day, there was another bombshell dropped on the earnings call. A big one. An activist investor has entered the chat.
Yeah, Elliott Investment Management, one of the biggest names in the activist game, now owns a big piece of Medtronic. And the company didn't waste any time. They immediately started running the classic activist playbook. Step 1, bring in new blood for the board. Step 2, set up a new committee focused on growth, M&A, the whole shebang. Step 3, create another committee to just focus on cutting costs and being more efficient. The message here is crystal clear. The pressure is on to get this stock moving and to do it now.
And of course, management is trying to frame this as a positive. The CEO, Geoff Martha, came out and said, Medtronic is turning the page. He's trying to sell this story of a new era of growth. You know, they're not fighting the change, they're leaning into it and telling everyone to get ready for something big.
So all this talk about growth, where's it supposed to come from? Well, it all comes down to the product pipeline. They're betting big on the future.
And you want to see proof that their strategy can work? Look no further than this number. A 72%, that's 72, increase in U.S. sales for their cardiac ablation business. This is all thanks to their new pulsed field ablation system, or PFA. It's an absolute monster, and this is the kind of home run they're hoping to hit again and again in other parts of the business.
And that potential is why you have to pay attention to this timeline. These are the dates that matter. Coming up this fall, we've got the new CGM launch for diabetes. Then, October 8th, circle that date. That's the big one. A final decision from Medicare on their new hypertension device. Later in the year, we're hoping for U.S. approval of their Hugo surgical robot. And then eventually, the spinoff of the diabetes business. I mean, the company has basically staked its entire reputation on hitting these milestones.
So, with all that on the table, where does the stock go from here? Let's get to our take. This is the next call.
Okay, here's our call. For the next quarter's results, we're expecting them to be pretty much in line with expectations. But you can bet the commentary from management is going to be super bullish. They have to keep this story going. For the stock price, we think it's going to be stuck in a range, pretty much treading water until we get to that big October catalyst. So our official rating is market perform. This is the definition of a show-me story. The promise is huge, but now they have to actually go out and do it. Execution is everything.
So, that leads us to a specific trade idea. We think the market isn't fully appreciating how big that October 8th decision is. It's a binary event, meaning it's basically a coin flip with huge consequences. If that hypertension device gets CMS coverage, it's a game changer. A massive new market opens up overnight. If it gets denied, ouch, it's a huge setback. So either way, the stock is likely to make a big move. So the idea is to go long volatility heading into October, basically betting on a huge swing that other people might not see coming.
And of course, we have to close with this. Please remember, this is not financial advice. All investment strategies and any investments you make involve the risk of loss. Absolutely nothing you heard in this explainer should be taken as investment advice.